Economists are trying to gauge what impact the Ukraine war will have on the U.S. economy and on inflation to figure out which force the Fed needs to confront right now.
Today, I'm announcing the United States is targeting the main artery of Russia's economy. We're banning all imports of Russian oil and gas and energy.
Holdouts, but the social pressure has continued to grow, and several companies have now announced they will stop doing business in Russia.
It's virtually impossible to assess probabilities because you're dealing with human behavior at an individual's level, and we just don't know that person well enough. We don't know how Poland's going to fit into this, where Russia's line's going to be, who's going to side with whom. We don't know what it means for the Middle East. We don't know what it means for China. We can make a bunch of assumptions. So I think it's best not to try and be too clever, too cute, pick the exact scenario, but go at the toppest level macro to say, okay, what are the things here that can help protect me? And those will be gold, bonds, dollars. And I like crypto, but I would prefer it if we had the central bank printing. It feels for crypto very much like the setup in 2020 in March, when we sold off really hard, failed to make a new low versus the low a year and a bit ago prior, and then took off. We haven't made a new low. We've thrown a war at crypto. We've thrown, Chinese bans. We've thrown all sorts of stuff. 8% inflation. Central bank with an expected 8 rate rises, which is never going to happen. And crypto didn't make a new low. So I think there's a signal there, but again, we need to watch it. I don't think that's the bet to put all your money in right now. All of my money's in it, but I am adding to these other trades. The crypto situation gets interesting, I think, as people start to realize that at sovereign level, this becomes a solution for them too. And the rise of central bank digital currencies, they're moving away from the SWIFT system. That's all coming into this game. And the dollar's a big risk here. So if you get a liquidity squeeze, the dollar goes up. The dollar's the one thing that I'm looking at, but we also know that the Fed try and stop that because they know the dollar is the wrecking ball. They can't let the dollar go up too fast. So they start supplying the world's banks with swap lines. So every time they've done that in the past, it's eased the issue. But here you've taken out a very big economy. I mean, Russia's gigantic. Russia probably has more natural resources than the rest of the world added together. It's something of that magnitude. So the GDP may not be big, but its asset base is enormous. And without that in the world, we end up with a huge loss of trade. And we've also got these dollar liquidity issues, which I think will bite the Europeans, bite the US, and bite everybody else. So I think that's all setting up to be a bit of a mess. The Fed will come in and try and flood the market with swap lines. So the money printers start in different ways. And I know there's a lot of people who watch this go, well, that's not money printing. It's enough to start changing the denominator effect of certain assets. So be cautious of that one. I actually like bonds in this environment because if you raise food and fuel and input costs, you're destroying demand. We've already seen demand slowing globally. We're already seeing a lot of forward-looking indicators. I've written a lot in it, and I wrote it up in the GMI that you all got. I think everybody got it. There's so some of my thinking about all of that, and I've been writing about that frequently in GMI and Macro Pro as well, to talk about how that's playing out, but it's playing out exactly as expected. The world is starting to slow down. The US is starting to slow down. Bond yields are starting to come off. And I think even with higher prices, I know everyone thinks it's inflation. I think it was a massive tightening of monetary conditions and total demand destruction on lower middle class households. So I think that is a big problem coming. And I think bonds should fall in yield. And, right now, US bonds are a safe haven. So there's safe haven flows that come into that as well. I think generally speaking, bond yields should come down towards the 1% level. And let's see, are we building structural inflation by the changing of supply chains, or does that get solved by technology? So I think the Europeans are going to start dealing with pain via fiscal stimulus. I think they're going to have to give people money to pay for the rising cost of fuel and food. That's an MMT style transaction where essentially it gets monetized by the ECB. Now, if this flares up further with Poland and NATO and Russia, I mean, there's no way they can justify having that reliance. So that's a complication. There are side deals that can be cut. Russia and Germany have direct pipelines. There's, again, I don't know, but we need to be very cautious of how this plays out. That's the carbon situation, because, carbon credits has been a trade that I've been in for a while. They've had a huge sell-off. I actually quite like it. But again, it's much less clear at this situation. So I will give you that. I'm not sure. Bonds, I think, are a decent bet. gold, for the reasons we talked about, are a decent bet. Long term, I think it plays into what crypto is and means in this world. A distributed network that's not owned by anybody but owned by everybody is almost priceless in a situation like this. So it's not very clear. Equity markets are troublesome. I've been waiting to buy tech, and I don't think we can get there until we start to see the monetary spigots opening up again. And I think they will come, and I think they'll come in form of transfer payments. People are going to get really hurt by the situation of food prices and fuel prices. Now, can you trade commodities? Can you expect them to go further? The hard thing is we don't know. A resolution that half of these commodities are down 50% in minutes. So it's a really difficult world to try and own them, and volatility is high, so it's hard to own calls. So to make sense of the world, buying commodities doesn't feel like a good bet. The ramification of the high commodities, which is slowing growth, makes bonds a good bet. The ramifications of the weaponizing of reserves makes gold a good bet. The dollar is generally quite a good bet on a massively key level against the euro. I've been tweeting about this. If it breaks the kind of 109, 108 level, I mean, it's going down to 80 cents. I think that's probably likely over time, but I think the central banks will step in first to try and slow it. It probably goes down over time because Europe has no choice now but to militarize. So Germany has kind of kept away from doing that. Most of the nations had. They're now going to probably have to break their 3% budget deficit, implied rule that they never stuck to. But the Germans can't increase its military or its spending to NATO without doing that. They're going to have to do that in this situation. So even in scenario one, with the dirty compromise, the Russians, the French, the Italians, everyone's going to have to spend on military. So there's a huge boom in the industrial military complex, as ever. Those guys make money out of everything. But that means that deficits run and the euro potentially weakens over time. And it weakens over time also because Europe is threatened. So do you want to own your money in euros? Less likely. The US is much more removed from the situation, again, is much more attractive. And Europe just hasn't been producing the kind of growth that the US has at corporate level. So I think the euro falls significantly over time until maybe Europe has bolstered its defenses and we have some resolution of this situation. If Russia hadn't invaded, then I would have seen a reversion. But now I just think the world's going to have to deal with having to find new supply chains. In that scenario one, I think there's going to be a weakening in sanctions on Russian commodities. So they'll sanction them on a bunch of stuff, but they'll say through the back door, listen, we need the copper, we need the nickel, we need the oil, we need the gas, which is a bit of a shit show, but that's kind of, I think, the state of the world. It just depends how tough Europe will be on this and how much pain it will take, which again is, I think it's fiscal. So once we start seeing fiscal stimulus, obviously risk assets tend to outperform because the denominator falls. It's another thing to remember with news flow. There's an enormous amount of propaganda from every side. So you don't know the truth and you will never know the truth. You will never know whether Russia is exactly meeting its plan or whether every tank is falling apart because it's ancient and the Russians have no will to fight. All of that is propaganda. What the truth is, nobody knows. And it's usually a bit of both. So just again, keep your filter up. Just filter it out and just look at the top level. Where are things moving? What is going? Without trying to be too clever in making assertions, because I've seen many people blow up their entire P&L by thinking they know what's going on when really they don't. Anyway, best of luck out there. Sorry, it's horrific times. Everybody's trying to scramble to get an idea. And I think geopolitics is about to be a much larger part of what we're going to have to deal with, which I don't like because it's all so unknown and everybody can sound smart in geopolitics by sounding scary and shocking and everybody wants to listen. So just be careful of that too. Anyway, best of luck, everybody. And I'll touch base again soon.